How low can you go on your interest rate? That's one of the questions that we're going to answer here in 2024 on this channel. People have been sitting on the fence for quite some time waiting to buy a house because they're waiting for interest rates to drop. Well, one person says the Fed hasn't dropped the rate all year long. Well, another one says the rates have gone up and down. We're going to talk about why those two things don't line up, how interest rates are set, what it looks like from a governmental perspective, and what it looks like from a personal perspective, how your personal factors will affect you. Hi, I'm Jason Wilson with Ursula Associates. Welcome to the channel. Please give us a thumbs up or a subscribe or even a comment to let us know what you think of this content. We're trying to give you guys the information as consumers so that you can make the best decisions possible. And this is a little bit of how it was made version of interest rates. So let's get into this. Okay, so welcome back. First thing we have to talk about is the number that bases everything, and that's what's known as the Fed fund rate. The Fed fund rate is where the Federal Reserve, who has the ability to print money, we're not going to talk about that though, but let's say they have all the money. The banks you borrow from don't actually have the money, they get it by borrowing it from the Fed. The Fed will lend to that bank at a certain interest rate. Whatever that interest rate is what's called the Fed fund rate. Then a bank will likely have to lend that out at a higher rate so that they can actually make money on it, right? And the difference is going to be that first factor that we're going to talk about. So number one is called the spread. The spread is going to be the difference between what the lender is lending to you at and what the Fed is lending to your lender at, right? That's the reason there's two interest rates. Currently, at the time of this video being done, which is June 25th of 2024, what we see out there is that the Fed fund rate is sitting at 5.5. It has been for the whole year. I believe it was 5.25 before that. So that's kind of the floor of where we're starting at. Now, there's always going to be some fringe things that go above and below these, but let's just keep this basic in the lines. If 5.5 is what they're borrowing at and they lend you at 5.5 without charging you fees to make up money on the front end, basically they're doing it for free, right? So that means the rates are going to be higher than that. So let's talk about why you're not paying 5.5% right now in the market. And the reality is the lenders need to make money, and they make money in two different ways. One is going to be points or origination fees that they charge to create the loan. They use terms like discount points. That upfront money sometimes is the money that they're going to make over the long term of the loan. The more of that you pay up front, sometimes the lower the interest rate can be, so you're paying less over time, but you have to balance those two things. If I pay you $10,000 today and you lower my mortgage payment by $100, how many months of $100 savings before I get back the 10 grand I just spent? So you're going to want to be clear on that. But the number one is the spread. Number two is the bond market. This is another factor. So because the Fed lends at this rate, the bond market is going to be a huge indicator at what the spectrum of loan rates are going to look like, the high and the low. So the better the bond market is doing, the lower on the spectrum, the closer to the Fed fund rate you are. The worse the bond market is doing, the higher on that spectrum would be. So what they're basically saying is the investors in the market, if their confidence isn't so high in treasury notes, in the future of money, then they might bump rates up to make more money in the short term to be able to make that worthwhile. The worse the volatility is in the bond market, the higher the rate goes. Number three, historically speaking, when confidence is in the market for money to go into Wall Street, then it tends not to go into bonds as much. Bonds tend to be lower yield. They tend to be something that's safer, right? They don't have as much volatility as the market. But if the market is hot, people might want to put money in there instead of in the bond market. And that oftentimes, and there are exceptions, would cause bond markets to be not as good and rates to go higher on the spectrum. Remember, they're going to sit on the spectrum. We're all on the spectrum, right? It's going to be somewhere in that between that 5.5 and whatever the height that it can be. If the bond market is just absolutely tanking, it's entirely possible that you can see 8%, depending on if it's going to be a non-owner occupied investment property, it could be even more, right? So you could see those type of things. But you conversely, if the market is rallying and doing well, especially the bond market, and money's flooding into there, that rate could pull closer to the 6s, right? So it's going to get closer to that Fed fund rate. Number 4, this is pure speculation, but when the Fed announces what their plans are, right? Just the news. We plan to do 3 rate cuts this year. Well, all of a sudden, the investors feel more confident long-term, they'll throw some money into the bond market. The market will rally, rates will get better. They end up not doing cuts, or they say we're not going to do rate cuts, but we're actually going to do rate hikes. In most cases, this will cause the market to go the other direction. There are, in fact, reasons that the opposite would happen, but we're not going to get into that in this video. We're talking about just some of the fundamentals. So those are kind of the 4 things that, from a governmental standpoint, that affect the interest rates. The Fed will start it and lay it out. And then number 1, it's the spread between whatever the Fed fund rate is. Number 2, how bond markets work. If the bond market's rallying, prices get closer to the Fed fund rate. Number 3, if money's flowing into Wall Street and not into the bond market, the rates actually go the other direction. And that number 4, if the Fed announces news in favor of rates coming down or in favor of rates going up, the investor market will respond to that news, not necessarily even their action, but to the news of it, and it will have an effect that will pull it towards the Fed fund rate or away from it. Obviously, the last one we haven't talked about is if the Fed lowers the floor, then there's room for it to move back. Does that make sense? If they lowered it to 3, then that would make more room, but you're not going to pay the Fed fund rate because you're not a lender borrowing money. Okay, so where do we stand today? As of today, on the spectrum where we would sit, depending on what lender you use and what closing costs you're willing to pay, which includes the points and the origination fee, you're somewhere between 6.5 and 7.125, generally speaking. But there are 5 factors that affect that, and you can go a lot higher depending on those factors. Let's talk about what the factors are. Number 1, your credit score. Your personal credit score, if you're buying it as an individual, will have a dramatic effect, at least on the conventional level, of where you fall and what you pay. Number 2 will be your credit history. If you have a killer score, but you don't have deep credit, meaning you've got one credit line for 1 year, but you got a 750 credit score, your score is good, but your history could restrict your ability or make you higher risk or even get you denied. Number 3, debt to income ratio. If they were to make the loan that you're requesting, and you calculated all of your debt servicing costs, what percentage of your income is that? They like to see the lower the ratio is, the better things will go. For example, we had somebody buy one that was really high on their debt to income ratio, but number 4 came into effect, which is loan to value, meaning what level of down payment they were going to put. If you're going to max your DTI, you want to lower the LTV. So the debt to income ratio, they want to keep that somewhere under 45%. In some cases, it goes high as 55. We're not going to dive into that right now. So if it's 45% of your income, what would help your rate be slightly better is, let's say you're putting down 40% on the purchase price. So if you're buying a $500,000 property and you're putting down 40%, you're going to be lower on the spectrum than if you're buying a $500,000 property and you're putting down 5% and you're maxing the DTI. Those things can get you towards denial or at least paying a higher rate because the risk is better. So if you have a lower DTI and a lower LTV, those are both going to help out a lot. And the last one, number 5, is going to be the type of loan product. For example, if your credit was within the range to qualify, FHA will have closer and more similar interest rates across different credit spectrums, relatively speaking, with some exceptions, where conventional will be a lot more volatile based on bracketing of that credit worthiness. The better the credit, the less you will pay, generally speaking, to a certain point. You'll get the best rates that are available. But the type of loan product also would affect it. Let's say you're getting 30% loan to value, low DTI, you got a killer credit history, killer credit score, but you're buying an investment property, a short-term rental. Well, since it's the type of property in the loan product, I can reasonably have seen a loan close in the last 30 days that was at 8.125 because it was an investment loan, right? So they know that loan exists for income purposes. It's not your personal residence. So despite all of those other factors, you're still paying above what you would had it been your primary residence. So remember that primary residence is going to be a factor. But those loan products, FHA, VA, and then you get into conventionals, Fannie Mae, Freddie Mac, and then the down payment that goes into those. When you're greater than 20% down payment, you avoid PMI, which is private mortgage insurance, which will increase your payment and affect your DTI. So those are all the factors that go into this. So what does this all mean and boil down to? Well, two things I wanted you to get out of this. One was whether the Fed raises the rates or not, the rate can fluctuate. Two, you need to shop it because different banks will cut out margin to do different deals with you to get a deal done today. There are certain products out there where I have seen them in the high fives and in the mid sixes, where others are going to be in the sevens, even though you're shopping the same product across different banking platforms. So you're going to need to do that. Number two is talk to a real estate professional that can actually guide you through this. All right, if you just went through this video and you actually watched it, thank you for that if you did. But with all the math back and forth on this, you might go, this is not for me. But if you hire a professional, they can guide you through it and say, well, what category are we in? Put you in the right loan product and then help you find the right house. Buying real estate is still a great investment, and I highly recommend it. It's the number one way the American dream is achieved, where people get to levels of financial well-being through real estate. If you own your own house and you have no plans of ever selling that house, but you are thinking about investment property, give us a call and we can talk about what investment rates look like, how the rules are slightly different, even though the same principles of the Fed fund rate apply in getting your interest rate set. We can talk about cash flows and the four other ways that you make money inside of real estate. Thank you so much for sticking to this. If you made it to the end of the video, please give us a subscribe and a thumbs up. We really appreciate you, and we will see you soon.